Hi, everyone. This is Kevin Brinkman, and you're listening to the Brinkman Report. Today, we're going to provide a boots on the ground, in the trenches, on the front lines, behind the curtain look at the multifamily market and our specific markets in the Mountain West. I just wanted to get as many metaphors lined up in a row there. I'm lucky to have our COO of Brinkman Real Estate here, Dan Metzger, and our CFO, Peter.yoo. Thanks for joining today, guys.
Thank you.
Thanks for
So
having
I'm
us.
going to start with national trends, just to give you a feel of where we think we are in the cycle. And then these guys are going to dive into our specific markets and specific topics. So first, this is data I got from Marks and Millichap, and it really tells a story of the impact that the historic amount of new deliveries of apartments has had. And so that's when we look at the performance of our assets, the value in different markets, the biggest impact has been this historic amount of new deliveries. And on the right here, you can see that really peaking, we believe in 2023 was the peak of those new deliveries. And then really since then, really dropping off a cliff. I like the word historic because it really is. These type of numbers has only happened one other time in the U.S. history. That was in the 1970s. So for the last almost 50 years, we haven't had this many of units under construction. And that has been the biggest impact in each market. And so the question is that we'll talk a lot about today is in each submarket, how many new projects are there, where are they at in delivery, and that's really going to determine what the supply and demand side is in each of those specific markets. The good news from at least um, a gross market point of view is how much new starts have dropped. So as I mentioned, peaking new starts probably in 22, and those have dropped almost 70%. And that is the biggest delta on record from the peak to the kind of the trough that we're in now. And you can see it's almost like a 2011, 2012 coming out of the GFC. So that's going to have the biggest impact on our market. And then this is another graph that shows the dark lines are those same apartment completions by quarter, by year. And the orange is absorption. So you can see we did have negative absorption in 2023. And the only other time we had that in the last 20 years was during COVID. But since then, we've had really strong absorption. And that's even with these historic high deliveries. And I think we're very fortunate that we did have this soft landing in our economy. We've had a very robust labor market with very low unemployment. And so demand for apartments has been very strong. And so we were very fortunate, I'd say lucky, that when we had this huge supply of units, that we had a really robust economy and labor market, that we actually were able to absorb those. And that's reflected in this Wall Street Journal article that just came out last week, where the titles were headed towards a landlord-friendly era, expect higher rent prices. And I think that's a good snapshot of where we believe we are and where we're going. And we think that in vacancy is as well. Dan will talk a little bit more submarket by submarket, but this is on from a national level. Dark lines again are completions, and you can see this is again Marks and Millichap data that they believe that vacancy rates have probably topped out in 2024, and then that the trend is going to start coming down as a reflection of a lot of these projects and units being absorbed and less supply. So on the supply side, this is something Jay Parsons put out that I really like. There's a lot going on here, but it's ultimately a per market. When are we gonna get back to below COVID averages for supply? So when we look at all these new units, when you look at, okay, when are we going to get back to normal for new supply? It's really, in Denver is really reflective, a lot of our Mountain West markets, that it's really this year, probably second half of 2025 that will be a little bit more back to normals from a supply point of view. Dan will show a little bit more how Salt Lake is different than all the other markets we're in, where they've had more deliveries that they're probably another year to get those absorbed before they start getting into equilibrium there. So, real estate is always cyclical. I always like taking a big step back and, okay, where are we at in the cycle? I think it's pretty clear that 2022 was the peak, and that was just, a mix of low interest rates and a lot of capital availability and a little bit of euphoria. And so you'll see in the next slide how we believe values were peaking in 2022. And then for the last, 2 years, they've been coming down. We believe we have hit bottom from a value point of view. And that was a mixture of the peak of these deliveries, so a lot of supply, and a peak of interest rates. So you put those two together, there weren't many transactions, and the ones that were at lower values. And then we do believe that we are starting to come out of this recovery. There are very few investors that I talk to that are waiting because they think there's going to be better buying opportunities, that the biggest discounts are in the future. I think most people think we bottomed out, and now they're kind of dollar cost averaging, looking for good deals coming out of that. And I think this is reinforced by a Bloomberg article that we're showing here. The black line is apartment values, and you could see the same thing as what I just showed. 2022 is really being the peak, and then values have come down, right around 20%, but then bottoming out in 2024. So we do think we've gone through the cycle and we're starting to come out of that trough. And I think some of the data that Dan's going to go through on what we're seeing in each market for actually getting back to rent growth really reflects that. And then also what Pete is going to share on interest rates, and it's in capital markets where that's finally stabilizing, that I think we'll get some stabilization in values, and that starting to come out and increasing in property and portfolio value again. So let's go over to you, Dan. So that was kind of on a national level, and so everyone knows Dan has our asset managers and our whole portfolio ops that roll up to him. So he's got a really good insight on what's going on at the property level and in each market. So Dan, would you give us kind of an overview on what you're seeing in the markets that we're involved in throughout the Mountain West?
Sure. If it's okay, I'll go ahead and share a chart of my own here, table, I should say. All right, so this shows our multifamily markets, and it's sorted by the percent of inventory, the total inventory in each market, what is under construction currently. The third column shows what CoStar is projecting for year-over-year rent growth for 2025. This includes the 4 quarters for 2024, basically how each of those quarters, are projected to grow over the same quarters of 2024. So with that, there's just a few things I wanted to highlight on here. First, many people have heard the story of Boise, Idaho, and just how much supply has come in there over the last few years. Most of that has been delivered. Right now, Boise's experiencing, or currently has, about 4% of their inventory that's under construction. And so much of the supply that has been delivered over the last few years is now in lease up and being absorbed. So just interestingly, CoStar is projecting actually some decent rent growth in 2025. So that's very positive over there. The other one I want to highlight, just specific market, is Missoula, Montana. Missoula experienced significant deliveries primarily in 2022. That's when we saw a really big spike in deliveries in Missoula, and since then it's still been higher, but it's come down significantly. Right now there's about 4% under construction of the total inventory under construction in Missoula, and there that's where we're projecting to see our largest rent growth of all of our markets in 2025, from about 3% to about 5.5% over the course of 2025. So that's a good story there. What's not a good story is really Salt Lake. As many people have heard, the Utah uh, markets, whether it's Ogden, Utah, Salt Lake City, Provo, which is where we have properties in each of those markets. It's been very, a lot of supplies delivered over the last few years, and there's still more coming. And that is really what is behind these negative rent growth projections for 2025. Again, projecting, very limited or very minimal negative rent growth to very minimal positive rent growth in each of those markets. In Provo, Utah in particular, that 11% really represents one of the fastest supply growth rates of similar sized cities in the US. So significant there. But the good news, once we burn through, as we're starting to see in some of these markets, once that supply really comes down, the rent growth is going to be coming. And we're projecting, once this supply gets burned off, really in kind of 2025, in some cases 2026, 27, 28, 29 are going to be very positive, because there's just not much supply that's coming in behind it, because these projects take several years to be constructed. So the other thing I just wanted to point out is in many of these markets, really the luxury Class A tends to take on the highest pressure from supply, because most of that supply is being built in the luxury Class A property type. So that's where you see the highest vacancy rates. It's where you see the highest use of concessions. Most of our properties in these markets are really a step below those luxury brand properties. We have very nice assets. They provide, quality, safe place for our residents to live, but our assets just don't have the top of the line property amenities that these luxury properties do.
Yeah, it sounds like some great tailwinds moving forward, and it's great to be in a position where we were talking about negative rent growth over the last 12 to 18 months, and to some of these on the upper end of some of these ranges back into 3 to 4%, and that's this year, and we feel moving forward it's going to be stronger than that. So that's a big part of it. I know concessions has been a big part of the market as well. Could you talk a little bit on what you're seeing there?
Absolutely. So concessions, they remain prevalent in most of our markets. Once you start them, they take a while to pull back. Residents get used to them. So, but I'm expecting anywhere from about 2 to 4 weeks across our portfolio for 2025. So
That's great. Yeah, I know we in one of our asset management meetings last week at one of our properties, the neighboring property that we've been competing with, they finally took down their 1 month concession sign. So I think that's a good sign of the trends that we're hoping that more and more of these concessions are going to be able to kind of go away moving forward.
Yeah, that was up in Kalispell. We
Yeah.
also, at one of our properties in Salem, we've decided, we've hit a nice high occupancy, and we've decided to pull back concessions. It's not to say we won't put them back in, if occupancy goes down, but somebody's got to be the first to do it. So
Yeah,
we're gonna
and
try.
those are great trends at this time of the year. So could you talk a little bit more on the seasonality and what we saw in the winter leasing season?
Sure. Yeah. Winter's definitely, it's seasonal again. It used to be a couple years ago. We really didn't experience seasonality, but definitely seasonable again in the winter months. We have really made it a big focus of ours to manage our rent roll to minimize the lease exposure in the fourth and the first quarters. And that, in particular, this past year, we made an aggressive push, in Q3 to renew these tenants, as many as we could, and to fill vacant units going into our slow season. So our portfolio occupancy at the end of 2023 was about 92.5%. And at the end of 2024, we were at 95%. So definitely, we put ourselves in a better position going into, the slower time of year.
Yeah, and I always think of the stats on single family home sales and how muted that has been, just because of the higher interest rates and and also not a lot of people aren't selling because they've got good interest rates that they locked a couple years ago. So what are we seeing for retention? Because I think retention has been a strong point as well, right?
It has. Yeah, we've done a good job this past year. It's been a big focus of ours, and we've seen positive results. This year we took really some specific measures to try to increase our retention. Probably the biggest one was increasing renewal commissions for our staff at many of our properties. The cost, for an extra $100 on a renewal commission, is a pittance compared to the downtime, the turn costs, all the cleaning costs, all the things that go with receiving a vacant unit and trying to release it. So that was a big focus of ours this year. We've also done a good job at early outreach. At some of our properties, we were noticing a trend where on the with new tenants coming and looking at the property, they were looking several months out, and so we took that and we started to reach out to our existing residents sooner as well to try to lock them in. And we've also done some raffles, early bird, different ways to try to get residents to respond to those renewal offers sooner.
I know one of the litmus tests that we look at is bad debt for tenants is kind of it's seeing the financial kind of well-being of the market we're in and our tenant base. Would you first start just a little definition of bad debt and then what trends we've seen there?
Sure. Yeah, bad debt is basically the loss of revenues from residents that either did or that skip out on their lease. We saw this really creep up in 2023, and it's remained elevated since then, but not a material change in 2024 over 2023. We've been looking at and working through some different strategies with our third-party operators to try to mitigate bad debt, including increasing security deposits, some changes to our screening criteria, switching out collection agents, so to some that are getting better results. On some of the states, cities, that we do business in, they do put limitations on what landlords can do, as far as security deposits go, as far as some of the screening measures. But we're doing what we can under the under the constraints that we have to live under.
Gotcha. Wanted to hear a little bit on the labor market and staffing. Every property has on-site staff from community manager to leasing to maintenance. So, labor is pretty impactful for our operating expenses. What trends have we seen there?
Yeah, labor is very impactful. In 2023, it was an absolute game of musical chairs where, staff was going to, the highest bidder. From our standpoint, we've got 18 multifamily assets. So that equates to roughly 40 or 50 different employees that are all, managed under third-party groups. But, we tracked this, and, unfortunately, there was a stat which basically at least every month last year, we lost at least one staff member at our assets in total. And, the reasons for departure are they're much more varied than they were back in 2023. Some are leaving property management, some are moving out of state. You've got some going back to college. And then there are some that switch properties, but we have really tried to focus our efforts on retaining, the strong on-site staff that we have. And sometimes that means paying them more, sometimes, increased bonuses. In many cases, it just simply involves a thank you. But we definitely see a continued high correlation between performance at the property and staff tenure.
And then so positive rent growth, we think moving forward. So the other piece of that is really managing those different line items from operating expenses. And we're coming out of a very inflationary time. What are the ones that you're keeping a good eye on that you're concerned about moving forward?
Sure. Yeah, overall things are getting better. Definitely. We talked about payroll. It's still, it's gotten a lot better. It does still tend to be, higher than the overall inflation rate. Insurance is definitely something that has been a roller coaster the last few years. we have had some improvement there, and I know Pete, who heads that our insurance program, is going to talk a little bit more about that. So I'll let him touch on that. Utilities continue to be higher than inflationary. These costs, the utility costs, are typically billed back to residents. So while it doesn't have an impact on our bottom line quite as much, it does impact their total gross dollars that they can pay in rent, and therefore it puts downward pressure on base rental rates. Probably the last one I'd touch on is taxes, and these have been mixed. We definitely have seen increases across many of our markets. We've also actually seen taxes come down in a few of our markets, and this is really the tax assessor's recognition of the drop in market values. But in many of our markets, 2025 is a reassessment year. We get reassessed every 2 years, and so it's going to be really interesting to see what happens with values in those markets. But we definitely will be appealing in all of them. Yeah.
Well, appreciate that. And I think that's a good
Yeah.
segue over to Pete as we're talking about operating expenses. So everyone knows all of our insurance program, financing all rolls up to Pete as our CFO. Could you give us a little, we'll start on insurance and then go to financing. Will you tell us a little bit about what you're seeing in the insurance market, Pete?
Yeah, so as Dan mentioned, insurance has been fairly volatile, and it's hugely critical to our properties as it's typically the second or third largest expense line item on our P&Ls. So what we saw really in 21, 22 is we saw insurance start to creep up about 10 to 15% each year. Luckily, we've seen what we've heard this going into this 2025 is that the reinsurance markets, so the companies that insure the insurers, have renewed their premiums at about a 4 or 5% discount to the carriers. That savings will hopefully trickle down to us as the final users and payers of that insurance. That we'll see some savings on the property side, and hopefully also or some savings or possibly some flat renewals on the property side for our properties. The biggest challenge that we're seeing going into 25 is really then the general liability, so the GL market and the excess liability markets, where there is continuous litigation for slip and falls or incidents that happen at properties that are starting to cost the carriers more and more money. And so those types of incidents are really pushing the premiums. And what we've heard is that we're anticipating about a 12 to 15% increase in our general liability coverages for 2025.
So I know a metric we always look at is the cost of insurance per unit. How are we looking there, and what are the trends that you're seeing?
Yeah, so in 2024, our cost per door was about $379 per door, which is, I think that's a pretty good number. We've seen some of our peers and stuff are in sort of the 500 plus per door category. We're seeing some of our renewals. We've already had some renewals kind of coming into 2025. We're anticipating, our premiums to be closer to about $362 per door through 2025 or as they expire into 2025. That's about a 4.5% savings over the last 12 months on our renewals that we've had from that 24 to 25 year.
Yeah. So those are good trends, right? We're little softening in our insurance premiums. We believe that we'll be able to protest some of our property taxes as values have come down. So we're starting to see, and as Dan mentioned on the labor side, we're not having as much of this pressure on OpEx that we've had over the last couple of years. At the same time, as we mentioned, we're going to experiencing positive rent growth again. So these are a lot of good trends that are coming together at the same time. Pete, let's go to financing now in the capital markets. Would you give us kind of an overview of what you're seeing there?
Yeah, so I've had an opportunity to speak with some of our banking partners and some of our capital markets partners. Overall, we're seeing a trend in sort of a tightening of the spreads over whatever sort of index they're using. So I think they're actually trying to create a little bit more competition between banks and the agency lenders and life cos, and that we're kind of seeing a general kind of move back to groups wanting to lend again. That's kind of the high level across all lending platforms anyway.
So then what specifically are you seeing on unconventional getting back in the market? Are they getting a little bit more aggressive?
Yeah, so the conversation I've had with our banking partners certainly indicate that they've all kind of used the same words. It's funny that they've all kind of said they have a mandate to go out and lend more this year, to get more aggressive, to go find new customers. They're all, it's kind of varies by asset type of what they're looking for. There's still groups that are not looking for office, but most groups are really looking for multifamily. That's a very solid asset that I think that they're all willing to lend on. They're seeing, we're kind of seeing spreads on the bank side be about 190 to 225. They're using different indexes. Some of them are using SOFR, some of them are using treasuries.
Hmm.
They do feel like the general consensus is that the credit folks, the people that are in charge of really approving these loans, they're loosening up some of those credit standards a little bit to try to be more aggressive, to go win more loans, to try to be more competitive with the agency lenders and those types of things.
Gotcha. How about the life companies? I know that's a big part of the market as well.
Yeah, it's a big part of the market. And unfortunately, it's a market we haven't touched on a lot. Although we do still get life quotes on a lot of the projects that we're trying to refinance. They haven't really fit with what we're trying to do. What I'm kind of seeing is that where they're quoting stuff around 200 to 250 over the treasuries. There's still a reluctance for them to lend sort of outside bigger markets, so they're geographically constrained in some ways. They're also somewhat constrained on various asset types. They won't do, a lot of them are looking for sort of the better, Class A, Class B type stuff, and the Class C and workforce housing type stuff is a little bit more of a challenge, although there are life cos out there that are willing to do that.
Gotcha. So our core business, if we can get agency debt on every one of our acquisitions, we will. So that's Freddie or Fannie. A lot of there's not debt coverage ratios, which take a little bit of risk off, and usually kind of the best terms and longer duration of financing. So the agencies are hugely important to us. What are you seeing there?
Yeah, the recent quotes we've had with the agency has been really in the 140 to 150 range on the spread over the treasuries, which you can also, with the agency, you can buy that down at any level of paying, 1% of your proceeds to 2% of your proceeds to get up to about 34 or 35 basis points. So we're even seeing with the buy downs, you're seeing spreads at, just over 100, maybe 110 basis points over the treasuries. So that's been really great. We recently were quoted a deal where we were an all-in coupon of about 575 to 582, depending on the product that the agency had, which that was kind of your all-in coupon rate. But with the buy down, that really worked out to be like a 5.4 to 5.3 kind of range. So really competitive on the agency side. The challenge with the agency is that, sometimes the proceeds aren't exactly where you're trying to push them to, and you'll be DSCR constrained out of the gate. But to your point, Kevin, they won't have ongoing DSCR testing and those types of things.
Yeah, I'm kind of amazed where some of the agency quotes have come in, where you can get that mid to low fives right
Yeah.
now. Is still, pretty attractive. Appreciate you guys. Any kind of last thoughts? Maybe I love predictions. So how about both you? What do you think the 10-year is going to be at the end of this year? Is it going to be above 4.5, between 4 and 4.5, or below 4?
I think this is your favorite question. Do you ask
This is my
do you
favorite
poll
question.
your family at this every night at the dinner table?
Exactly, right. My aunt, my pets too.
Yeah, right.
Pete, you want to go ahead? I'm happy to.
Yeah, I mean, get out the crystal ball, right? But I think we're not seeing a lot of movement in the treasuries. I think there's been a lot of volatility in the last couple of weeks, especially. I mean, we're seeing sometimes 10, 15 basis point swings in a day and certainly over a week. So I think we're going to see some of that. I think the good news is that hopefully it'll sort of stabilize, but I think it'll stay somewhat flat. I would say we're going to be over 4, but under 4.5, I would say, by the end of the year.
And I think they're going to stay fairly flat. I don't see
Yeah.
huge movement either way.
I think that's the reality. I think those property owners that were hoping to be saved by lower interest rates to refinance or sell, yeah, I think the reality that's probably not going to happen. So it's really these trends that we're talking about in demand, supply, and OpEx. I think are going to be the favorable conditions moving forward. But even just stabilizing interest rates, I think will be a benefit to the market. So, well, thanks for joining today, guys. We'll put your contact info in the show notes if anyone wants to reach out to you directly. And then we'll see everyone again next month. Thanks for
Thanks
joining.
for having me.
Thanks.